Hello and good afternoon, everyone. I'm Preeti Mishra and I head marketing for the Treasury and Capital Markets vertical of Intellect Design Arena. I'm thrilled to have the opportunity to host you today. These are difficult times and I appreciate your presence in today's session. When we talk of NBFCs, we are aware that NBFCs in India hold a significantly large portfolio. Their smooth functioning is essential for the growth and development of the Indian economy. I'm sure the learned audience in today's webinar realize that more than ever, asset liability management assumes greater importance for NBFCs. How can we help? Welcome to the webinar on Answering to RBI's Liquidity Compliance Mandate for NBFCs. Today's presenters are Mr. Anjan Chatterjee, Head of Pre-Sales for Risk and Treasury at Intellect Design Arena, and Ms. Namrata Shah, Head of Product Engineering for Risk and Treasury at Intellect Design Arena. Now, without any further ado, over to Anjan and Namrata.
Thanks, Preeti. Hello, everyone, and welcome to today's session on Asset Liability Management and Risk Management and Governance Program. This is Anjan Chatterjee from Intellect Design Arena, Treasury and Risk Division. Before diving into the nitty-gritties of the product, let me introduce Intellect Design Arena as a technological leader in the fintech space and what it does and what the product involved around. Now, Intellect is a global leader in financial technology business based out of India. Intellect has been in business for more than 25 years across various functions like risk, treasury, capital markets, global transaction banking, consumer banking, and insurance. Intellect provides a full spectrum of modern, high flexible, robust, and integrated products that run over in 240 plus financial institutions globally. This actually brings out the global footprint of Intellect Design Arena and its capabilities. And as you could see, it reaches right from North America, well over to Europe, to Middle East, African countries, Asia Pacific region, Australia, and I have also listed all the brand names and the banners which we are serving at the moment. So we have a host of commercial banks using our contextual ALM. We have names like Samba, we have names like ABC Banking Corporation, then we have J&K Bank, Fino, and in NBFCs we have NABARD, which is a huge brand name in India, along with HUDCO. In the insurance sector, we have United India, and in central banks, we have RBI. And hereforth, we introduce the product which we call CALM-20. This is contextual ALM, which we have named. And before introduction to these platform and what the capabilities are, let me introduce one other aspect of why this webinar is so important today, and what is our net message to the NBFC sector in India, where our product CALM-20 will become the differential factor in governing their business and reaping heavy harvest profits. This slide is to bring out what is the need for RBI to talk to the NBFCs of late from May 2019. There is a set of instructions and governance structure laid down by RBI for the NBFCs in India, and this emanates from a few challenges of late the NBFCs in India have been facing. Now, the NBFCs in India are holding a significant amount of large portfolios. Their smooth functioning is very, very essential for the growth and development of Indian economy. Now, recently, NBFCs have found them to be constantly facing problems and in managing their liquidity position owing to multiple factors such as increasing borrowing costs, asset liability mismatches, repricing risks, nature of assets, and reluctance of lenders and investors. Hence, considering all these things, balance sheet size and importance of NBFCs to Indian economy, the regulatory authority, that is RBI, has decided that it is really important that they bring these NBFCs under the same guidelines and governance structure which they have already issued for banks. Now, if we look at this circular at a glance, there are 8 salient features which binds the total governance structure which RBI has prescribed for the NBFCs. Just quickly touching these areas, like the NBFCs are required to have a very firm and transparent LRM policy, and their strategy and practices needs to be documented and well led. The next one is to have a robust management information system, followed by robust internal controls, maturity profiling, followed by measurement, which is the stock approach. Then there are guidelines led to measure and govern currency risk and interest rate risk. And obviously, they have prescribed the liquidity risk monitoring tools, which is the LCR and other aspect, which have a very keen resemblance with the Basel III. This talks about the contextual ALM value chain. So at the end of the day, what is the value Intellect's CALM 20, which is the contextual ALM product, is bring to the table for NBFCs? Now this value chain has got three large benefit blocks, I would say. Number one is the coherent data fabric. Number two is balance sheet risk algorithms. And number three is analytics or advanced analytics, I would say. Now, coherent data fabric, just to introduce the concept. Now, most of the person who's in an ALCO committee or in treasury in financial organizations would appreciate the fact that any ALM application or any ALM platform at the end of the day sits in the coherence of a large amount of external other systems the organization have enterprise-wide. Like it interfaces with treasury, with core data, with lending systems, and all this data gets assimilated into the system at the end of the day, churning with the policies and the regulations which are prescribed or the organization being governed by, throwing out the respective analysis, the reports, the advanced visualization on which the treasury manager and the ALCO committee can decide. Now, these three large areas, coherent data fabric, balance sheet risk algorithms, and advanced analytics, comprises of a couple of, I would say, setup internal to them, like how coherent data fabric is used. This is a unique product of Intellect Design Arena. It's a firm-wide unique thing which enables any application to do integration with any amount of other system in a seamless way, like transaction capture of different asset classes, transaction flow, the cash flows, generation and aggregation of those. All of these gets assimilated into and taken care by coherent data fabric. Moving on to the balance sheet risk algorithm, obviously it takes into account the risk policy of the organization and the regulators. Algorithms are set for all balance sheet risk, which with the help of these two, the data which is assimilated in coherent data fabric gets churned, and then the following result will be the different regulatory reports, advanced visualization, and risk aggregation and reporting functionality, which we will cover under analytics. So hereby we are going to introduce the coherent data fabric. So as I explained earlier, that a system like ALM, any ALM platform, sits in the plethora of huge amount of other systems an organization uses, like different asset class, treasury, core banking, lending, and at the end of the day, the data feeds from all these areas and gets churned through its algorithms, giving rise to the required regulatory report, the dashboards, the advanced visualizations and all. And all this is taken care with what we call a data fabric, which is very unique to Intellect products. Now, this is a standard enterprise integration platform in a way. It's a very robust systems, and it is capable of handling multifaceted interfaces with various upstream and downstream system on a real-time basis. Now, obviously, among all these interfaces, one side we have the banking books, and also we do interface with the trading books. This is the main purpose where the ALM sits in a very strategic position, and thus integrating these two, the balance sheet of the organization is formed, and thereby throwing up the gaps, different results of different stress testing and liquidity measures and governance and other monitoring tools. This is also a future-proof, cloud-ready microservice-style architecture. End-to-end integration of lifetime monitoring is possible here. Thus, the net results are quality, speed, scalability. That's a competitive advantage one would have And obviously, all these would add up to profitability. This is what the data fabric does to the ALM support system. So after churning of all the data, what is thrown out of the systems are under these heads. Like we have different liquidity risk analytics, which we achieve through this ALM system, which includes like different liquidity projections, risk model configuration, balance sheet ratios. All the balance sheet ratios are calculated here. Now we touch upon the norms of Basel III liquidity ratios also. Then the liquidity gaps are generated, and then respective analytics in relation to behavioral analysis is also generated. Then balance sheet forecasting is done. Stress testing results are achieved here. On the funds FTP, that is the fund transfer pricing side, we use match maturity method, and different spreads of liquidity, credit, capital allocation, and capital costs are kind of calculated here. And then obviously the actual and forecasted balance sheet can also be visualized from here. Okay. Now on the interest rate risk analytics, we have got interest rate exposure. Then net NII is also calculated here, and then interest rate sensitivity analysis is also what is an outcome of this integration of data and ALM churning. Then we can achieve duration analysis. Then the VAR testing, and the stress testing itself can be achieved here, and contingency funding plan. Large fund providers, liquidity asset profiles, these are all taken into account. So basically what is happening here in summary is the banking books, which consists of loan, deposit, mortgages, credit card services, savings accounts, and etc., gets integrated with the trading books, bonds, securities, and vanilla derivatives, mutual funds, etc. And all these data are kind of churned up in the ALM platform to give rise to these benefits. And we are about to discuss the balance sheet risk algorithms. Now, moving on to the next slide. So this is the full spectrum of the balance sheet risk algorithm, which are housed within the CALM, that is Contextual ALM of Intellect Design Arena. Now, there are basically 6 levers we are talking out here: capital adequacy, leverage, funding, liquidity risk aspect, interest rate risk, and market risk. Now, we see from this diagram that the 6 levers or the 6 cogs of ALM are projecting certain benefits to the organization. Like capital adequacy shows the ALCO committee or the treasury head or the management of the company that whether the capital is enough to absorb the projected losses, or tier 1 capital to total assets ratio assets to equity is an outcome from the leverage cog. Now funding will tell you the right mix of liabilities and liquid assets and fund transfer pricing. Liquidity risk lever will obviously give the gap analysis and all the regulatory gap analysis regarding related reports. Under interest rate risk, we have interest rate risk sensitivity, and in market risk we have market risk on the trading books. These are basically captured in a very user friendly way into reports, so that the treasurer is able to take a very informed decision. I will now hand over to Namrata to take you in more details through all these levers. Thank you.
Thanks, Anjan, for providing detailed view on contextual ALM value chain and Coherent data fabric, which is one-stop solution to all integration challenges which one can face in ALM solution. As Anjan has already provided you with an overview of 6 important levers in the balance sheet risk management, so now let me take you through each of the 6 cogs in detail, along with how Intellect CALM solution address to each of it. As you can see on the screen, first important lever in the balance sheet risk management is capital adequacy. Capital adequacy is one of the most important and mandatory requirement for survival of any bank and the institution. Intellect CALM 20 product is Basel III compliant with SMM and IMA, that is Standardized Measurement Method Model, as well as Internal Model Approach. The CAR model illustrates a bank's core capital in relation to its risk-weighted assets on an ongoing basis for all the treasury and money market products. Thus, the top management of any bank can identify whether there is an underutilization or an excess leverage. Product also facilitates FIs to monitor regulatory capital requirements. Various other reports which gets generated through the application helps to assess if there is enough capital to absorb treasury losses and also take more investment or a trading risk to increase the profitability. Since market risk is major component of treasury, capital charges on market risk we will touch upon shortly. Now let me take you through the next cog in the chain, that is leverage. As we all know, leverage helps FIs to assess its reliance on a mixture of equity and debt, or you can say other assets and the liabilities. The regulators have specified certain critical ratios, as you can see on the screen, with respect to liquidity risk management for banks and FIs to monitor. In fact, for NBFC, RBI has stipulated as recently as in November 2019 various critical ratios to monitor and ensure that they are adequately leveraged against fund mismatch, losses, and defaults. All these ratios are pre-configured and readily available under CALM-20 solution. Let me also tell you one more thing, that product offer a very flexible module that allows user to set standard ratios which are stipulated by regulators as well as other ratios of any account head as desired by FIs from time to time depending upon the business strategies and the market conditions. The solution also allows capturing and comparing the ratio outcome against industry average as well as internal limits. From operational efficiency perspective, I would say system allows to define as many ratios as a user want into the system for monitoring and decision making. It really helps to determine if any strain on the assets or if the bank is over leveraged. There is no limit on the type or the number of ratios which one can set using this application. As we are aware, the funding risk is analyzed by liquidity stress testing to find out if the institution's funding source would be enough to withstand unexpected market disruption, giving its balance sheet composition, funding profile, and the business strategy. Just imagine a situation where a fund manager is stuck with the excess fund at the end of the trading hours, or maybe a shortage, I would say, leading towards the likely limit violation. I would say as a solution to this situation, CALM-20 product provides daily gap report. This report helps the manager to monitor and analyze funding gap on an ongoing basis. Report also helps in analyzing liquidity contingency plan and the asset buffers. Another module, that is fund transfer pricing. Module helps in ensuring the demarcation between the market risk and the credit risk by passing on an appropriate cost of fund to the respective owner of the risk. Solution also takes into consideration the assets maturing in short, long, and a medium-term time ladder, and it also seeks to balance it vis-a-vis liabilities also maturing across short, medium, and a long-term time ladder. The gap report typically points to the funding gap and the excess fund at a different point in time. Product also covers concentration of funding by counterparty, by product type, concentration of counterbalancing capacity by issuers, price of various length of funding, rollover of funding, forecasting of LCR and NSFR. Additionally, it also covers cash flow projections under different scenarios and generate the necessary stressed, regulatory required buffers and contingency liquidity matrix. Moving towards the most critical cog now, that is liquidity risk management. It is every bank and the institution's worst nightmare of not having enough liquid asset in hand to meet daily obligations. As we know, liquidity deficit even at a single branch or the institution can lead to a system-wide replication. So it is always important that banks and FIs are prepared before a shortfall occurs. Keeping latest regulatory guidelines in mind, Intellect CALM-20 solution is built to provide in-depth liquidity risk management with multiple dimensions. As you can see on the screen, and to just name few of them, liquidity projection, parameter adjustment, liquidity analytics, stress testing. To start with the first one, that is liquidity projection, solutions support a cash flow calculation engine to generate future cash flow for assets, liabilities, and off-balance sheet items from 0 day to 50 years and any extended period as required. Time-bound regulatory reports are generated just by a click of a button, and that is also on a daily basis. This report helps in keeping an eye on liquidity gap as well as monitoring stipulated gap limits. Solution is further extended to incorporate PC-based guideline and generate LCR report on a daily basis. Keeping design thinking principle in mind, complex Basel rules are built with simplicity and flexibility, giving full control to the operational users to set HQLA principles, various risk weights, and the haircut percentage as applicable. System also supports generation of NSFR and various other monitoring tools which are required for some of the FIs in a specific region. To achieve accurate projection and analytics, solution supports dynamic parameter adjustment maintenance like limit, reserves and spreads, behavioral estimates, and so on and so forth. Product provides regulatory as well as various liquidity analytics with help to analyze all assets and liabilities maturing in short, medium, and a long-term time ladder, along with funding gap and the excess fund at a different point in time. Dynamic gap report helps to simulate future gap positions for forecasted business volumes and exercise of options. Along with maturity ladder, solution also provides facility to analyze concentration risk through various other sets of report. As we have already covered a different dimensions in previous slide, I will not go into more detail about this point. Regarding the stress testing, solution offers institution-specific strains, market-wise stress scenarios for individual variables, market-wise stress scenarios of multiple and combined variables. Advanced analytical part, that is LCR analytics, also supports on-demand scenario and stress LCR analysis. The risk that gives headache to all bankers, financial leaders, and borrower is the interest rate risk. ALCO ALM committee, headed by top executives, meet weekly or more frequently to take a vital decision on interest rate changes on loan as well as on deposits and the tenor bifurcations. Intellect CALM 20 solution is packaged to address this IRR needs. Solution provides multiple reports like interest rate sensitivity, NII, and NIM. These are the reports which facilitates to take a better decisions. Solution helps to monitor interest rate sensitivity by generating interest rate sensitive gap reports. Report provides a cash flow laddering based on repricing profile and frequency of interest rate sensitive assets and the liability. Modified duration report helps to measure net present value of the loan portfolio or simply bond price under different interest rate conditions. For example, one need to analyze by how much percentage the bond price will be affected by a basis point up or a down move in the interest rates. The resulting output helps users to determine the modified duration or simply interest rate sensitivity of the net present value or a bond price. DV016 to calculate the dollar value by which the market value is affected by basis point expected movement in the interest rates. It's common to find leading banks setting internal limits around these measures to manage interest rate risk in the balance sheet. FIs can assess the impact of the interest rate changes, new business, change in the product mix, and rollover of deposit or net interest income. A number of tools which are readily available in CALM 20 solution to gauge the IRR on real-time scenarios as well as stress conditions. Analytical reports for shocked NII, NIM, and impact on economic value of equity, bucket-wise closure cost, factor sensitivity, interest exposure and concentration thereon are some of the exclusive MIs which are available as part of product for decision making at the right time. Moving towards the last lever, that is market risk. CALM-20 solution supports end-to-end market risk modules starting from traditional standardized measurement method till internal model approach to estimate losses and capital charges as per the latest Basel guidelines. Risk weights are computed for every treasury transaction to assess the capital charges to compute the final CAR. Under SMM, duration-based sensitivity is computed by taking disallowances for a short position in trading book. Specific risk is also computed as per rating and other counterparty credentials. Under IMA, advanced tools and computations like VAR, backtesting, CVA, etc. are available on the platter with no manual intervention. Traditional methods like duration approach is also parallelly available in the solution. Stress testing of interest and yield curve are also offered as a flexible module to conduct parallel and non-parallel sensitivity analysis on assets and liabilities. The user can perform granular shock to identify product line-wise impact of profit, loss, and capital thereon. As we have covered details around 6 important COGS and how CALM-20 solution address to each of it, now let me take you through balance sheet risk analytics module under CALM-20 product. Solution provides balance sheet risk analytics around various areas like liquidity risk, market rate risk, interest rate risk, and Basel III liquidity. Stress testing and simulation of various assets and liabilities under different scenarios are available in the module for better profitability and improved capital planning. FTP module helps in providing a basis for exchange of fund between different business units. The output measures the profit contribution of various lending and borrowing units of the banks and the FI. As explained in earlier slides, system also supports measuring and monitoring of capital adequacy with emphasis on market risk, liquidity risk, and the interest rate risk. With multidimensional data availability under ALM solution, that is data at transactional level, product line level, business line, and a legal entity level, CALM-20 solution provides efficient data analysis and detailed view via a very powerful dashboards. Dashboards are specifically designed keeping in mind important factors like better efficiency for the risk managers, easy monitoring of complex structures, easy access to the alerts and exceptions, quick drill down for detailed level data on the need basis. Now let us zoom down to few of the visualizations. As we all know, risk mitigation strategies are a top concern for senior executives, CFOs, and risk managers. Need of an hour for them is to have a holistic view which can help them in viewing the liquidity ladder, cash flow projections, and portfolio concentrations. CALM-20 solution provides number of interactive dashboards which can provide aggregated view of liquidity that perfectly matches with the compliance and the management need at the strategic level. As per the latest guideline, LCR maintenance and monitoring on daily basis is mandatory. In addition to the standardized LCR report, solution also provides anytime dashboard that gives visual representation of LCR. As you can see on the screen, top portion of the dashboard shows the total LCR along with the breakup at various levels. As you can see, like HQLA, level 1, level 2A, level 2B, total outflows and inflows. Comparative LCR details and analytics are seen in the second half of the screen as a single view, which you can see on the left hand side, and on the right hand side you can see a drill down view with the detailed data analysis. This dynamic dashboard helps to explore large portfolios with the flexibility to drill down at the granular level. On the similar lines, product also offers dashboards on interest rate risk. As you can see on the screen, summary dashboard provides portfolio-wise, bucket-wise cash flow up to 50 years in a single view. This dashboard helps the risk officer to analyze the situation time bucket-wise with zoom down to a specific portfolio as needed. These are only a representative dashboards. CALM-20 is designed to have many more such dashboards for various balance sheet analytics. Well, I have given you a glimpse of Intellect CALM 20 solution. Now let me hand over the session back to Anjan.
Thank you, Namrita, for your detailed explanation on the balance sheet risks. I would like to also take this opportunity to introduce that Intellect Design Arena also has a full suite of treasury requirements and treasury platforms for NBFCs. We have the capability of taking care of all the resource mobilization part and the investments and hedging. So under resource mobilization, we have domestic borrowings and deposits. We support issuances. We have a very robust and up-to-date MIS system. We take care of internal borrowings and foreign currency loans as well. And on the investment and hedging side, we cater to the needs relating to investments in mutual funds, taking care of bank deposits, currency and interest rates hedgings also are supported, and all fixed income investment products. This slide talks about the awards received by Intellect Design Arena. Our solution has been recognized by and rewarded by analysts throughout the world and leading media publications in the fintech space. For example, we are also recognized by Risk Tech, Charities, IDC, and Banking Tech for ALM and treasury implementations. This shows the coverage we get from the different global analysts like Celent, Charities, and leading analysts have rated our solutions very favorably after going through detailed RFI responses and demonstrations, and have covered for us all ALM stress testing, data integrity with every controls we have. That is all for now. Thank you for patiently listening to us. Thank you once again.